Briefly introduce us, I'm Keith O'Donnell. So among other things that I do, I lead the real estate team within Taxand. And with me on the panel, I have two of my partners from the UK and the US, because as we'll see later on, these are the jurisdictions that in terms of capital flows into real estate are by far the most significant in terms of Chinese investment to date. So we thought we'd focus on the two of these and do a couple of short case studies on them. Positive side, we've seen an increase in REIT regimes, so real estate investment trust regimes. These have been running since the US first pioneered the concept many years ago, coming out of another real estate crisis. They tend to come back into fashion when particular markets need to provide a bit of support to their real estate markets, since they are fundamentally the thing that distinguishes a REIT regime from a publicly quoted company is basically a big tax break. So we have seen these recently in Ireland, Spain, Mexico, India, South Africa.
Looking at the UK, the REIT regime is actually in focus at the moment, and historically what has happened, the rules for getting into the REIT regime and having tax transparency through that vehicle have been quite stringent, particularly with regard to having really what were the large public quoted companies that were dealing in UK real estate. What we have now is a consultation with perhaps the outcome that it could be a more flexible regime. So to watch this space with regard to the UK, with the possibility of having more closely held REITs at some point in the future, which would be a sort of game-changing development in terms of structuring for tax when you've got outbound investors coming into the UK. So that could be big news in a year or two for us.
Just a few numbers here on the size of outward investments in China that we've been able to identify from various sources. In 2013, there's a figure which intuitively looks low to us, but it's the best that's out there, of about 8 billion of outward bound investment from China in real estate. Big predominance in commercial real estate, primarily between the UK and the US. So you can see that it makes well over half. And after that, it drops off sharply in the other countries. An interesting point, however, is this particular number here. Over 2012, there was already over 100% increase. Now, when we started off, we were trying to guess what this number here might look like in 2014, and we said, well, maybe it'll go from 8 billion to 10 billion. Just as we were discussing, we realized we were probably wildly underestimating this. And we suspect that number may go much higher. I mean,
amount of Chinese investment into the U.S. is very big. I pulled some stats before I came. They already represent nearly 10% of all foreign buyers of homes in the United States. They're the third largest buyer of homes in California, only second to the Mexicans and the Philippines, and the second largest buyer in New York. Which is, it's pretty incredible. And there's large commercial and housing projects they've invested in, well over 1 billion already in California. So I think the growth is very, very fast, and we've seen the demand for the work as well in our practice. So.
And really, when you're putting together a return, these are the three things that you see in a UK real estate return. You've got your rental income, interest deductions, capital allowances, and that's really what the game is about.
The U.S., as I said, very popular right now for real estate investment, not just from China, but really from all over the world, just like I think the case in the UK. A lot of investment coming in from Europe, South America, from a lot of developing nations where there's a need to move cash into what they perceive to be, and I say perceive because you never know what can happen, safer investment climate.
So hopefully in that brief slot we've managed to give you at least a flavor of the tax implications in the UK and the US for outbound investment from China. I think the key takeaways from my perspective would be, one, in both countries, tax rates can really creep up. I mean, JC was talking about effective tax rates in excess of 50%, which is obviously a huge effect on the return. Coming back to the buyer, I'd say to a buyer, if you're doing that wrong and you haven't factored in that 50%, one way of looking at it is effectively doubles the cost of your asset. However, we've also seen, I think, that with appropriate planning, this can be significantly reduced. And I think the other point to consider is when looking at real estate investments, which typically are relatively long-term, we've also seen that there's a lot of change. Some of it's positive, but unfortunately quite a bit of it's negative as well. And I think that's also something to bear in mind with any real estate investment. Over 10 years, these rules will change. So you do have to, when you're making that investment, consider how sensitive you are to increases in effective tax rates and what effect that has on the price you're prepared to pay for the asset ultimately.